Welcome to Heller-Hurwicz Office Hours, a podcast featuring University of Minnesota affiliated economists and their research. In this special series of the podcast, we're focusing on the policy priorities of the second Trump administration and how research can inform our understanding of a rapidly changing economic environment. The recent passage of the One Big Beautiful Bill Act by a Republican-controlled Congress has heightened concerns about the rising national debt and what it could mean for America's long-term fiscal health. At the end of 2024, the Congressional Budget Office projected that U.S. government debt held by the public stood at around 97% of gross domestic product and would climb to 117% by 2034. That's an amount greater than at any point in the nation's history. The new law added another 9.5 percentage points to that estimate. This rise in debt levels is set to occur against the backdrop of an aging population, rising inequality, and slower workforce growth. In this episode, Professor Hannes Malmberg will explore what these changes could mean for the nation's fiscal sustainability and how current policies are setting us up for resilience or risk. So welcome.
Thank you very much.
So this is a really timely topic, and it's based on this paper, The Race Between Asset Supply and Asset Demand. And this paper was given by a colleague of yours, one of your co-authors, Ludwig Straub of Harvard University, at the Jackson Hole Conference, this annual confab of central bankers and economists and people who are interested in monetary policy. So what was it like to have a paper presented at this conference?
Of course, it's an honor to be invited to have a paper there. It's fantastic to have such an audience listen. I wasn't there myself, but my co-author said it was a fantastic atmosphere, lots of great questions, and discussing these issues with people who are extremely interested in the things that we're writing about, which I think we should all be, because it's, of course, very foundational questions for the future economic health of the U.S.
Yes. So one of the questions I want to ask you is, why is the term race in the title? So you have this race between asset supply and demand.
Yes. So taking a step back, we want to analyze government debt, but also more generally the dynamics of interest rates and wealth levels in the U.S. economy. And the framework that we use to think about this issue is these two concepts of asset supply and asset demand, and clearing the asset markets, bringing those two things together. So asset demand is the amount of assets that households and foreigners are willing to hold in the U.S. So it will come from your pension savings, people owning houses, or other governments or investors in other countries investing in U.S. government bonds, for example. And the fundamental equality is that it has to be that the number of assets that people hold has to be equal to the number of assets that exist. So that's the other side of the ledger. What assets actually exist in an economy? And then we have all the houses in the economy, we have all the government debt in the economy, we have the whole capital stock of firms, all the machineries they own, and we also have this just the value of the profits that firms make in addition to just owning capital. So if you take, for example, Apple, Amazon, these companies are worth a tremendous amount of money, and those are assets that exist. You can go and buy them on the stock market. So we try to analyze this race, that we call it, between asset demand and asset supply. So why do we call it a race? Well, yeah.
I was going to say, yeah, so why do you call it a race? And obviously, and interest rates are a critical part of this discussion, the equation.
Yes, exactly. So where does the interest rate show up in this? And they show up that if interest rates rise, people are typically willing to hold more assets because it pays to pay off your mortgage quicker, or it pays more to have stocks that grow faster. So people are typically willing to hold more assets if interest rates are high. But the value of existing assets typically decline if interest rates are high, because if investment costs are high for firms, they might want to have slightly less capital-intensive productions. And if rates of return are high, then this discount rate, how much you value all those future profits of Amazon and Apple, that number will also go down. So then the equilibrium in the market says that if the the interest rate that makes asset demand equal to asset supply is the equilibrium interest rate. And the idea is that if you have that people want to hold much more assets, then you shift out asset demand, and then you actually push down the rates of interest. And the intuition you should think about here is that we all want to consume in the future. We all want to have a lot of money when we're old. And if everyone is chasing that, they're going to push down the returns on assets, because essentially there's you can't get a very high return if everyone wants to own those assets. And conversely, if you increase the amount of assets, for example, by the government expanding its debt, or maybe there are new inventions that create new firms that are worth a lot, then you have to entice people to hold those new assets, and that's going to push interest rates up. So that's the race, essentially, that if the supply of assets increase faster than the demand for assets, then interest rates have to be pushed up to entice people to hold those assets. And if the demand for assets go up, then the interest rates will fall, because essentially all those people willing to hold assets, they have to accept a lower return, because everyone wants to hold those assets.
And so I want to get to your findings, but before we get there, there is the decline in fertility, long-term decline in fertility is in your model, the aging of the population, rising inequality. So some of these sort of fundamental economic factors that are in the background. So we've been talking about the assets, the supply, the interest rates, but this is within a backdrop of an aging population with increasing inequality and slower labor force growth.
Yes, so especially the demographic trends are very central to this dynamic, and that's why the race metaphor becomes even more apt when we look to the future. Because let's talk about the aging of the US population. So aging comes from two reasons. One thing is that we tend to live longer, which of course increases the share of old people surviving. That force has, unfortunately in the US, actually slowed down a bit recently with the opioid epidemic, obesity. So life expectancy has actually not grown super fast over the last couple of decades, and even declined in some groups. But the other force that makes the population older is that you have fewer kids. And the logic here is pretty straightforward. If you live in a country that has 4 kids, then every generation is twice as big as the last one. So there's 1 million 60-year-olds, then there are 2 million 30-year-olds, and 4 million 20-year-olds. So you get an age pyramid that is very thick at the bottom and very thin at the top. But if you reduce fertility a lot, then you're going to essentially have more of a rectangle. And if you have less than 2 kids, then actually the younger cohorts will be smaller than the older cohorts. So falling fertility is a powerful force for making the population older. And fertility has fallen a lot in the US. It used to be above 3. Now we're actually down to 1.6. Which means that nowadays the population will be shrinking if it was only due to births and deaths. And that's also going to make the population much older.
Okay, I have to ask you one other, basic economic question. How does productivity fit into this equation? Because you mentioned you went from 3 down to 1.6, but, overall we're a wealthier economy. We can produce more with fewer people.
Yeah, we're not poorer actually in general. So it's not a story that we get much poorer over time. Productivity growth more than compensates for us being older. That's why we are more interested in the fiscal implication and the asset market implications. So let's go back then to the race and what aging does to that race. And what we show is that aging has 2 big effects on this race going forward, but they go in different directions. So on the asset demand side, how much assets are people willing to hold? Then aging pushes people to own more assets. And the reason is that if you look at how much assets you own over your life cycle, then young people typically have very few assets. They might occasionally even get negative assets if they borrow a lot in the beginning of life. They might have student debt, they might have mortgage debt, and so forth. Then assets rise very quickly until retirement. We accumulate 401k accounts, we pay off the mortgages, and then they typically stay pretty high. We draw down some of that wealth to live in old age when we're not working, but we also preserve a lot of that wealth. So old people have a lot of wealth, but they don't work that much. And young people don't have much wealth, but they work a lot. And that means that if you take the ratio of wealth to how many people are working in the economy, that tends to increase very fast when the population gets older. And that's our measure of asset demand, which is how much wealth do people hold relative to the size of the economic pie. So that's the one part. So let's start with that. That force has been going on for the last 70 years. So we have gotten older. That has been part of pushing down the interest rates. So if you remember that interest rates might have been higher when you were young, this is part of the reason that an aging population have pushed down interest rate by increasing asset
I
demand.
remember my parents had a mortgage and it was at, 11, 12%, for example.
Yeah. And some of that was maybe that inflation was higher back in the days, but we also show that even if you clear out inflation, there has been this long-term secular decline in the rates of return in the US economy. And we show that increases in asset demand has been very important for that. And that force will continue. So like looking ahead, we're going to have that an aging population will keep pushing up how much assets people want to hold, which tends to put a downward pressure on interest rate because everyone wants to own those assets, so they have to accept skimpy returns. Now the
show.
Now the but. Now the but. But aging has another effect, and that is that it places great pressure on government finances. And this is especially true on the federal level in the US, because the US federal government is sometimes jokingly called an insurance company with an army. And that's meant to summarize that the big expenses in the US budget is, apart from the military, Medicaid, Medicare, and Social Security, and especially Medicare and Social Security. And those are programs that are almost entirely geared towards old people, which means that the US government finances are also dramatically affected by this aging. And let's go back to that asset demand and supply thing then. If the US government doesn't raise taxes or doesn't cut down the generosity of these programs, then they will have to issue a lot of debt. So the race is that these old people, they want to hold a lot of assets. At the same time, we create a lot of assets to finance the spending on these same old people. And that's the race between asset demand and supply, which is that over the next 80 years, we will have that, the US population wants to hold more assets, but at current policy, the US government will keep creating those assets, and we show that the second force is actually much stronger. And if we don't adjust policy, asset supply will win this race handily, and interest rates will be pushed up a lot.
As I mentioned in the introduction, the Congressional Budget Office, CBO, they're saying their forecast looking at 2034, without, I think, any changes, you're at 117 as 117% of GDP, of gross domestic product. Now, you're going out to much farther. I mean, you're going out to what, 2100, right? Yeah.
Yeah, which might be longer than you might know anything about the future, but I think it's sort of key to show that these trends are ongoing. But yeah.
So I plucked this line out of your study because it stood out to me. In a quote, in our baseline, it is possible to push long-term debt to 250% of GDP without raising interest rates. So we're worried about 117, or we're around 97% right now. And you have at 250% of GDP without having an impact on interest rates. So unpack this for us.
Yes. So there's multiple things there. So that's, of course, a sort of very striking number. And it comes with some qualifiers.
It did, but it did stand out to me.
It does stand out, yeah. So I think that the first thing is that it's an eventual thing. So this is over the whole century. We can sort of keep increasing this. We shouldn't jump straight away there. And the second thing is that it has to come with actually doing a fiscal adjustment to stay at that level, because it's paired with another number that we find equally dramatic, which is that to bend the curve, we actually have to increase government revenue or decrease government spending by around 10 percentage points. And that means that, yes, if we sort of have a credible plan to do that, and we sort of gradually keep having deficits, we can maybe go pretty high. But bending that curve takes a lot of effort. And to put in perspective what 10% of GDP means, The US is currently having 17 percentage point roughly of GDP as tax income on the federal level. So if you would want to raise taxes to close this gap that we have in front of us, we're talking about 10 percentage points increase. And this tax ratio has been pretty stable since the 1950s. There are a lot of changes in tax policies, but there is little in the history of the last 70 years in the United States suggesting that people are happy to pay much more than 70% to the federal government. And what we say is that like either you dramatically cut Medicare and Medicaid or you dramatically raise taxes, which plays a pretty stark choice.
It is a stark choice. And so how concerned are you? I mean, after you and your co-authors, you finished this paper, because, if you look at my journalistic career over the past 30, 35 years, there's always been this concern about the debt and the deficit. And what I've noticed recently is that many people who weren't that concerned about the debt and the deficit over those years are now concerned, that they're thinking maybe we are entering an area where this is not quite sustainable. So I'm curious, what are you thinking?
I become very worried about the fiscal trajectory of the US doing this study. So I think that there is one sanguine part with that 250%, but then when I saw the type of things needed to bend the curve to actually stop there, and that's essentially wherever we stop, we have to bend the curve pretty sharply, I got more pessimistic. And I think you're right and that's actually one thing that we looked into. So we grew up, in the early 2000s. We lived in the 90s. We weren't that old then, our co-authors, but we remember also that, Medicare and Social Security will break us, those type of stories. So we actually went back to those stories and sort of said, like, did they pan out? Are we, again, these very pessimistic people and like it will actually be quite fine? And I think that the big difference with the predictions coming out from our paper compared to some of those predictions that came earlier was that those predictions were very concerned about the rising cost of medical care. So they looked at the tendencies in Medicare to see that the benefits per recipient grew much faster than average income in the US, and that if that trajectory would not continue, then we would have enormous problems, maybe already now. And we actually have bent that cost curve, so it's not that like we don't have this dramatic exponential growth in how much every recipient costs. But our prediction is not about that. We keep the spending relative to incomes of regular households fixed in our experiment. It's just about this age distribution shift. And that has grown worse as well because fertility has declined more than predicted. So we felt that this prediction comes from extrapolating trends that we know much more about, which is that unless fertility magically reverts very soon, and who knows, like the future is unknown, the age distribution is pretty locked in. But even if fertility reverts, the age distribution is pretty locked in because all those 40-year-olds that will be 80-year-olds in our prediction, they're already there. We already know that they're a very big size compared to the 0-year-olds that will be paying for those people. So like that's already baked in, that like that's locked in. And that's why I sort of grown worried about this. I think another thing with those pessimistic predictions is that the US fiscal situation isn't that good already. So I think that this is how it will start to look when you get bad predictions, that you have a deficit, primary deficit of before interest payments of maybe 3-4% of GDP, which is very high in a reasonably good part of the business cycle. And so I think that that's also, I think, why people get worried, that like they see the predictions worsen and they don't really see any solution in sight. And we're already in a very good part of the business cycle having very high debt levels and chartering the political landscape of the US. It's very hard to see where that grand bargain will come from. I think that's also a source of my worry.
Yeah, and I've been noticing, and more and more people seem to be quoting from the late Rudiger Dornbusch, who was a wonderful economist for MIT. I loved talking with him. And he said, and I jotted this down, in economics, things take longer to happen than you think they will, and they happen faster than you thought they could. And that seems to be a refrain that's out there about when people are thinking about the debt these days.
Yes, and I think there are some interesting or worrying tendencies where you see bond yields starting to creep up. And I think that quote it has probably a lot of truth in it. It's a little bit hard sometimes to capture in our models. So if you look at the mathematics of our papers, we don't really discuss those dynamics of the bond market suddenly losing faith in US government debt and so forth. But we do try to incorporate a little bit of that, where we just say, okay, so we have this debt trajectory, 250, and that just says that the total amount of assets that people want to hold in the US, they're enough to cover for those things. But then we say that, but what about government debt? Suppose that one big thing that holds up the US government is that the interest rate on US government debt is much lower than the rate of return paid on the stock market, say, or the rate of return paid to private companies. There's multiple theories of this. The US debt is a very safe asset, or historically has been. Also, there might be regulatory requirements that you need to hold US government debt. And then we play around with specifications where we put in reasonable numbers saying that what if a higher government debt forces you to pay higher interest rates? Maybe if you increase the government debt by 10%, you have to pay 0.1% more in interest rate. And then we do get into pretty catastrophic territory in the sense that if you don't tighten the debt fast, the type of surpluses that you need to bend the curve once you get there, they're very big. And then coming to your crisis question, and that's the thing that we don't cover at all in the paper because it's complicated model-wise, or we discuss it, but we don't cover it in depth, is this crisis thing. Because, of course, these things are also forward-looking. Government debt is a very special asset for two reasons. One reason, as I said, is that it's a safe asset, there are regulatory requirements. Another thing is that the ultimate payment of it depends on political processes. If you own a piece of land, that's a asset supply, but it's asset supply that's borne up by a market that's willing to pay rent for that land. The value of US government debt ultimately resides in that future American taxpayers keep voting for paying that debt and keep voting for not inflating that debt. And of course, that crisis dynamics can come from that particular thing, which is that if the market suddenly starts to doubt that, they see that there's no real compromise in sight here. We can't really see how they will bend this curve. They will probably conclude that the way forward is that the US will try to inflate away the debt. And they can do that in multiple ways. They can sort of force people not to sell it. They can have very low interest rate on it. They force banks to hold them. And of course, and then have high inflation. And once you start expecting that, of course, long run rates will start to rise pretty quickly, because who want to sit on the government bond for 30 years that pay 3% in interest rate when there's going to be 10% inflation 10 years down the road? That's not a position any investor wants to find themselves in. So I think that looking at the long run interest rates is a very important indicator for how the markets are thinking about these trends.
How much has the experience of Japan influenced your research, or did it influence your research? Because Japan's had a very high level of debt relative to its economy.
It really has. And I think that's where you should see that 250% number in, is that we say that one potential scenario for the US is a Japanese scenario where, you have a very aging population, you expand government debt, but you have all these old people that are willing to hold it. And then you can find yourself in a Japanese situation. And I think that now also the Japanese situation could be, will Japan manage to bend this curve or not? We don't know. Now Japanese interest rates start ticking up, so maybe there's also a Dornbusch dynamic at play there. But yeah, so that's what I think.
All right. Well, thank you very much. Really appreciate your time.
Thank you very much.
Hannes Malmberg is an economist at the University of Minnesota. Office Hours is a production of Matriarch Digital Media, hosted by me, Chris Farrell, executive producer, Twyla Dang, producer and editor, Beth Gibbs, music by Bob Bradley. A special thank you to Heller-Hurwitz's Hannah Fairman and Janine Sorrell. Subscribe to Heller-Hurwicz Office Hours to hear about the economic research being done at the University of Minnesota. And to learn more about the research we discussed today, visit hhei at umn.edu. Thanks for listening.